Clean drinking water, a dependable electric grid, and safe roads are examples of things we rely on in our daily lives. And typically, we only think about these things when something goes wrong. The same thing can be said for price stability, like turning on the tap or the light switch, expecting the goods and services we use daily to stay in a predictable price range provides our society with a sense of stability and order. And for the most part, price predictability has remained high for 40 years. But things are changing fast, and inflation has been growing at a rate not seen in a couple of generations now. Additionally, interest rates that have been very low for a decade and a half are rising at a faster pace than most of us have ever seen. Now is the perfect time to put inflation and interest rates in perspective. Welcome to the RhinoInvestor.com educational series. Like and subscribe to charge along with us. I was born during the Great Inflation, and there are some similarities to our current inflation and what happened in the 1970s. Prices are moving up quickly after a period of stability, large government spending increased demand, and supply chain shocks have happened now as they did back then, albeit for different reasons. For that decade and a half during the Great Inflation, quite a few handful of presidents, Fed chairs, and others tried without success to quell inflation. It's a complicated topic, but one thing that played a part was that many experts at the time felt that letting inflation run hot was okay as long as it kept employment high. When Volcker was appointed Fed chair in 1979, inflation was at 15% and, quote, going to 20% in his opinion. Depending on your perspective at that time, he was a villain or a hero, because his quick and large move up in interest rates created 2 recessions, losing 4 million jobs in the process. Many sectors of the economy suffered greatly in the 70s, housing being one many of us can remember. Can you imagine having an 18% mortgage? I've heard what Volcker did in 1980 referred to as economic chemotherapy. The economy did get very sick for a time, and many felt the cure wasn't worth it. But raising interest rates that topped out at 20%, Volcker felt was the only way to destroy demand enough to stabilize prices so we could move forward. By 1983, inflation was down to 3%, and we've had a relatively stable inflation numbers and job numbers for 40 years since. One thing economists say the 1970s taught us is that we can't let our guard down on inflation, because unstable prices ultimately lead to destroying jobs, not creating them. The Federal Reserve now has 2 mandates: to keep inflation low and employment high. And sometimes, like now, as was in the 70s, we see these 2 mandates get in the ring and duke it out. Maintaining a stable economy for 330 million people in as large and diverse a nation as ours is no easy task. It's as much art as it is science, and experts debate every year on what moves should be made and why. But in less than 2 years, inflation busted out from 1.4% to 9.1%. And interest rates didn't move at all, off the 0% mark in 2021 when inflation was starting. The Fed didn't start to raise interest rates until March of 22, and then moved them up quickly to 4.25% in 9 months. From here, the debate in 2023 is, has inflation peaked? Will this be a transient issue or a sustainable problem? As experts argue, it's important to realize that we just don't know. Even Warren Buffett got it wrong back in the 70s, as he stated in a letter to shareholders that inflation was here to stay. So where does all this uncertainty, price instability, and interest rate volatility leave us as consumers and investors? Well, concerned for sure. We don't like uncertainty. It's difficult to make plans when we don't know how much something is going to cost. And on top of it, our 401ks and brokerage accounts are reeling. There is no one-size-fits-all approach to investing during inflation, because circumstances are unique each time. However, there are some general items to consider. When inflation hits, it's more important than ever to review your budget and keep a 3 to 6 month safety net of cash available if possible. More than that, and the negative returns on cash could really hurt you. And if you're retired and living off of your portfolio, you need to communicate with your financial advisor about how your budget is impacted. We all spend money on different things. We all have different items on our wants, needs, and wishes lists, so we all feel inflation a little bit differently. In portfolios, traditionally bond-heavy accounts will actually be hit hardest during inflation because interest rates are rising quickly to combat inflation. This can be a double whammy to retirees that aren't diversified enough. For more tips on better asset allocation, circle back and see my video on Are You Invested How You Think You Are? 100% bonds has not been the most conservative allocation, and that surprises a lot of investors. Regarding investment types, tips can help, and so can adding commodity-type investments like precious metals, energy, and agriculture. Adding some real estate, or REITs, can help diversify during inflationary times, and you can lean more on consumer staple stocks, companies that sell items we always need to buy at almost any price. Just be careful about loading up on too many high dividend yielding stocks, as they tend to react negatively to rising interest rates, similar to bonds. For retirees, the rise in interest rates can be a good time to lock in higher rates on some CDs and other safer investments. Diversification is still needed, but it could offer an opportunity for safer investors to put money to work at better rates, and that's a positive thing. Like the stock and bond market, interest rates can be volatile too. Retirement investing is a long game, and it's never set it and forget it. We have a balancing act of keeping a long-term perspective with keeping up with the world of investing in today's terms, or risk falling behind. We can't control the markets, and experts have shown us exactly how difficult it is to control the economy. So it's best for us to focus on what we can control: our spending, our regular saving, and our regular communication with professionals we trust to help us find investments and strategies that can help us during inflationary times. Thank you for watching and being a part of the conversation. As a registered financial advisor since 1992, I'm happy to help you and your family reach your financial goals.